Many market observers have been puzzled by US technology stocks' remarkable resilience, particularly as valuations have remained elevated despite rising bond yields. A compelling explanation for this phenomenon may lie in an unexpected source: the Japanese yen carry trade. This financing mechanism has historically influenced global asset prices and is crucial in supporting the current tech rally. At its core, the yen carry trade exploits the significant interest rate differential between Japan and the United States. Investors borrow in yen at meager rates and deploy this capital into higher-yielding assets, predominantly US technology stocks. The trade's profitability hinges on this interest rate spread and favorable currency movements between the yen and the dollar. The current market environment has created particularly fertile ground for this strategy. Mid-2022 marked a critical juncture when the differential between US and Japanese real policy rates reached historic levels. This timing coincides remarkably with US tech stock valuations recovering following their initial sell-off during the Federal Reserve's rate hiking cycle. The correlation becomes even more striking when examining how tech valuations decoupled from their traditional relationship with 30-year bond yields and instead began tracking yen weakness. However, this relationship carries inherent risks that warrant careful consideration. The most significant threat to this dynamic isn't necessarily a US recession, but rather the potential narrowing of the actual rate differential between Japan and the United States. Recent data suggests this gap has already contracted by 1.3 percentage points, establishing a clear trend that could trigger the unwinding of carry positions. The risk scenario could unfold through two distinct pathways. A rise in Japanese real rates relative to US rates could strengthen the yen, consequently deflating US tech stock valuations, a pattern observed during July and August. Alternatively, correcting artificial intelligence-related enthusiasm could force yen-funded leveraged exposure to US tech stocks to unwind, resulting in yen appreciation. Current market conditions add another layer of complexity to this relationship. The trading environment has become increasingly challenging, with many foreign exchange traders operating under tightened risk limits following recent market stresses. This constraint is particularly relevant given the elevated volatility in rate markets ahead of the US election and the gradual shift in monetary policy stances, hawkish in Japan and increasingly dovish in the United States. The implementation challenges are significant. Market participants who experienced losses during the carry trade disruption this summer have reduced risk appetites, and their profit and loss cushions have diminished considerably. As one UBS FX strategist focused on Japan notes, traders currently have limited capacity to take on additional risks. This sentiment is echoed across the market, with many observers pointing to the high volatility environment as a deterrent to aggressive carry trade positioning. These dynamics suggest several key considerations for investment analysts. First, the relationship between the yen carry trade and tech valuations provides a unique lens through which to view market risks. Portfolio managers might consider long yen positions as a hedge against tech exposure, particularly given the potential for rapid unwinding of leveraged positions. Second, the narrowing rate differential trend demands close monitoring, as it could serve as an early warning signal for shifts in market dynamics. Looking ahead, the sustainability of current tech valuations may depend increasingly on fundamental factors rather than financial engineering through carry trades. Market participants should monitor several key metrics: the US-Japan real policy rate differential, yen-dollar exchange rate volatility, tech sector valuation metrics, and developments in Japanese monetary policy. While the yen carry trade appears to have been a significant factor in supporting US tech valuations, evolving market conditions suggest its influence may be waning. The narrowing rate differentials, elevated volatility, and reduced risk appetite among traders indicate a potentially significant shift in market dynamics. As these relationships evolve, investment analysts must remain attuned to these subtle yet powerful market forces that could reshape the technology sector's valuation landscape.